Are Fed rate cuts slipping away? Here's what rising energy costs could mean for your stocks, bonds, and crypto. If you've been counting on easier policy to lift markets, it may be time to rethink the playbook. Investor hopes for near-term cuts have faded as oil and gasoline move higher. Headline inflation pressure is back in focus, and the market narrative has shifted from how fast the Fed can ease to how long rates may need to stay restrictive. That change touches everything from growth stock valuations to bond yields and the appetite for risk. Energy is the swing factor. Higher fuel costs can seep into transportation and goods prices. Core inflation is still the Fed's anchor, but a persistent energy pass-through adds uncertainty and can slow the path back to target. With that, bets on early and multiple cuts are being scaled back. Data now matter more than timelines, and policymakers are signaling caution against premature easing. Equities are getting more selective. High multiple growth names and certain real estate plays face renewed discount rate pressure as earnings season approaches. Companies with strong cash flow, durable margins, and real pricing power are drawing interest, especially in defensive or essential categories. The market is rewarding quality over promises. In fixed income, parts of the Treasury curve have repriced to higher yields. That lifts the opportunity cost of risk assets but improves carry for short-duration investors. Credit spreads remain orderly for now, yet tighter financing conditions over time could test weaker balance sheets. Selectivity and liquidity matter. Crypto is feeling the policy uncertainty as well. Flows have turned choppier, and while ETF demand remains active, it is more discerning. Participants are watching volatility and funding dynamics as proxies for liquidity and risk appetite. What are policymakers watching? Services and shelter inflation, because sticky momentum there can keep policy on hold. The energy pass-through to costs and consumer sentiment. Labor cooling through wages and job openings, and overall financial conditions, from equity valuations to lending standards, that reveal the true stance of policy. What can you do now? Recheck rate assumptions in your models. Tilt toward quality balance sheets and reliable cash flows. Consider maintaining short-duration bond exposure for improved carry while staying nimble. Keep an eye on the next CPI, PCE, and labor prints, and be ready to rebalance if the higher-for-longer path persists. Read the full article at finlitica.com.